Goldman Sachs chief economist Jan Hatzius is here at Post 9. As always, you expected 140,000 jobs, got 177. Nice, pleasant surprise for you?
Yes, there were some downward revisions, so overall it was probably closer to a wash, but it could have been worse for sure. So, I do score this as reassuring. I think yesterday's ISM number was also less bad than certainly it could have been. I thought that was going to come down more. So I don't want to overreact to that. I agree with a lot of the things that Steve just said. But most recent information is certainly consistent with the economy not going into recession for now. That is our baseline, but there's still a very significant risk.
Does today change the odds of recession?
I don't think dramatically, because I think it's a little bit too early. There are a lot of distortions in the data at the moment, especially the hard spending indicators. But I still think that there will be a drag from increases in prices and therefore lower real income, a financial conditions drag, although that's smaller now than it was a few weeks ago, but these things can obviously shift. And then number three, uncertainty and the impact of uncertainty on, ultimately hiring decisions and capital spending decisions. So I think those things are still likely to hit. In our forecast, that's not quite enough to get you to a recession outcome, but I think it's still going to be a drag.
Question is when? When we expect this to show up in the data, and how surprising is it that it hasn't yet?
Again, I don't think it's super surprising that it hasn't shown up yet. In the employment numbers, I don't think it was ever close to the baseline that the April employment report was going to show a lot of weakness. You always want to know the numbers, but it's really more a May, June, July type of development. And I think the labor market numbers are probably going to be the most important for telling you whether we're going to avoid a recession, go into a recession. It's going to be important for Fed policy. So that's what we'll be watching closely.
What's the calculus now on Fed policy? This buys them some time to stay pat?
I think so. So we're expecting July now. We pushed that back from June. I mean, I still think that the distribution of outcomes is very wide because it's a genuinely difficult thing to deal with. You have a positive inflation shock and a negative growth shock, and relatively small changes in how big one is versus the other can give you a very different outcome. But our baseline is 3 cuts, 75 basis points starting in July, but that can certainly
And you launched your Q2 tracker yesterday at, 2.4?
Yes, that's right. It's Q1 took a massive hit from the weakness in net exports, probably a lot of distortions in there because there are a lot of statistical issues with the Q1 release, but at this point, we're looking for 2.4%. That's sure to change as we get revisions to Q1 and information about foreign trade and so forth.
So what do you expect as far as the message from the Fed next week about which one that's more worried about, inflation or jobs, which would point it in different ways on the mandate?
I think they have, again, an incentive to not commit themselves because it's still too early. I think their view is also, we haven't really gotten enough information yet. The economy nothing has really broken in terms of the labor market yet, but we didn't really expect it to be visible quite that quickly.
But what do you make of the argument that the market signals suggest to them lower rates? The Treasury Secretary pointed out the 2-year yield being below, the proxy for rates being below the Fed funds. The fact that inflation expectations haven't really moved up, and the Fed pays close attention to that, which would all point them to cut sooner rather than later.
Well, I think on the first one, I'd say the market is saying there is a likelihood that rates are going to come down over time. And this is a probability-weighted view, effectively. There's a significant risk that the economy goes into a recession, in which case the Fed would probably cut by a lot. That has to be priced. There has to be premium in the 2-year note. So I don't think this is a statement that the Fed should be cutting right now.
And as for the inflation expectation stuff?
Well, that's a reassuring point, but there's still different indicators out there. I think you put certainly weight on the market measures, and you also put weight on the surveys. They're telling you pretty different things at the moment. So again, an incentive for the Fed to wait for more information.
Okay, Jan, thank you very much for joining us with your first take on jobs. Jan Hatzius of Goldman Sachs.